Good afternoon, everyone. On behalf of India Factoring and Finance Solutions, I welcome you to today's chat show on factoring and trade credit insurance. India Factoring is a premier trade finance institution registered with the RBI as an authorized dealer 3, and we hold an NBFC factor license. Our flagship offering, the non recourse product, helps clients to avail factoring without the facility appearing as a liability in their balance sheets. Such niche, structured trade finance products offer ease and flexibility in managing working capital requirements for businesses. Businesses can avail an agreed percentage of the invoice soon after shipment or after the services have been rendered. My name is Ramanathan and I handle risk management for South Zone at India Factoring. I will be your host today. Our guest on today's show is a seasoned veteran in the field of trade credit insurance. Mr. Arun Soundarajan is the country head and CEO of Atradius India. For context, Atradius is the second largest global trade credit insurance company. That's big. His experience of 32 years in this field traverses through the entire gamut of insurance, including risk management, strategic planning, policy formulation, fraud prevention, collections, recovery, and he has worked across several sectors such as telecom, logistics, hospitality, and real estate. Mr. Arun did his bachelor's in commerce from Delhi University and went on to pursue his master's in management studies from the International Management Institute, which is also at New Delhi. Okay, with that introduction out of the way, I now welcome Arunji to the chat show.
Thank you so much, Mr. Ramanathan. It's been a pleasure to have come to your show and look forward to a very good and interactive session over the next 15
Thank you, sir.
minutes.
Thank you, sir. Sir, we'll just start with some introductions about the factoring product and all that, and the trade credit insurance. We would also like to have a background about trade credit insurance. So we are on the verge of Atradius 100-year anniversary. And though trade credit insurance has been around in the market since several decades, it is only in the last 5 years that we have witnessed a traction in the awareness of this product in India.
Yeah.
The regulators have taken many steps to nurture this product, while the product itself reinvents itself as time progresses. So, can you please take us through some recent developments in the trade credit insurance, scenario and how it benefits clients?
Yeah. Thanks for the introductions, first of all. I think trade credit has been there for a while, actually. It's been there in the world for over 100 years. We nearly are a 100-year-old company. So we are owned by Grupo Catalan Occidente, which is based in Spain, which is the largest general insurer in Spain. So they have a lineage history of credit insurance across Europe. So in Europe, it is very common for companies to take credit insurance, and being a Dutch company also, it's the Dutch, if you know, they're the ones who actually were the pioneers in merchants and merchantable instruments. So we come from a big lineage of trade, and which is why in India we've been the oldest here, which has been over 20 years now. We've been offering the credit insurance product for all our customers from 2004, to be honest. We have a tie-up. In India, as you know, that we are a cross-border reinsurer, so we can't issue the policy directly. So we issue it through our partners. We have two partners, New India Assurance, which is the largest general insurance company in India, and also HDFC Ergo. So this is how we operate in India. So worldwide, yeah. So this is something that both our partners, in fact, we were the first to introduce the product in India. But you're absolutely right. In initial stages of its evolution, it started in a fairly exhaustive way that we were able to, do policies for banks, for factoring companies, etc. Pre 2010. Now, in 2010, the government, the IRDA, came up with a guideline that the credit insurers can't issue any policies to banks and factoring companies. And the reason for that was there was a little limited understanding of the product, and it created an issue in terms of claim payment, etc., and unscrupulous underwriting being done, etc. So that resulted in actually a ban in the product in 2010. Now, we had a lot of portfolio which are finance based and finance backed. And that came as a bit of a shock to us because then all our big policies would then go, which did happen. But it also gave rise to an opportunity for us. So the opportunity was that you're selling the product for people who want the product for its actual purpose, which is default risk mitigation. So so I would think that the entire phase of 10 years was more of a learning for us and also diversifying for us because of the ban on banks, we could actually do pure trade credit, insurance, which is, as I said, what the product is for. A seller sells to a buyer, the buyer doesn't pay, then we indemnify the seller. That's really what the genesis of the product is. So, having said that, we actually increased our portfolio within the last 10 years. It came to actually almost zero, but we started with a clean slate and went towards building our portfolio across the 10 years. So, it
Okay.
gave us a lot of scope and understanding on various industries. So, we were not restricted to one industry. So that resulted in a huge diversification of portfolio. So this happened over the last 10 years, and you're absolutely right. In the last 5 years, we've seen a huge uptick in the demand for credit insurance. Although the new guideline allowing the insurance companies to offer credit insurance products to banks and factoring companies came as late as 2021. So the period between 2010 to 2021 was a period where I was talking to you about that we diversified into various industries. So we can actually offer this product across industry, whether it's services, it's manufacturing, it's chemicals, it's pharma, it covers a lot of industries. So we have a huge portfolio. The only sometimes industries that we may not be very comfortable with is probably things like gems and jewelry, which we don't know. We're not completely aware of that, the working of that industry. It's a bit of a kind of a family-driven industry. So besides that, anybody who sells on credit, anybody who does a trade transaction, does take this insurance. So we have the portfolio consists of SMEs, MSMEs, large corp, mid cap. It covers the whole lot. To be just briefly tell you, it covers businesses as low as 100 crores to as high as 100,000 crores. So that's really the range. Of course, the top end is very few, but the mid range would be the sweet spot. I would say would be around 1,000, to 5,000 crores of turnover, which we likely to insure. So the government in 2021 came up with these regulations. They allowed us to issue policies to banks and factoring companies and NBFCs. So that was the big shift that happened in the last 10 years. So if you ask me the growth of TCI in India, there were two phases. So the first phase, three phases actually. The first phase was before the ban happened, then during the ban happened, and then after the ban happened. So we thought that there would be a large uptick in the issue of bank policies, but it has not been. It's been muted because of the fact that uh, there are these issues for Indian banks because they don't get capital relief. Is that there is a requirement, the rationale for that. If you're not going to give capital relief like you have in international banks, so most of the offtake we see is happening from the international banks because they manage to get some capital relief in their parent country, and they use the credit insurance as a risk mitigation tool, a CRM tool. In India, so far, the RBI has not allowed capital relief, so there is no weighted average relief that they can get because of TCI. So that's one of the dampeners, I would say, for the growth of credit insurance in the banking sector. Also, they also have, it's not a guaranteed product. At the end of the day, it's an insurance product, right? So with the SMA norms that the banks have, has to be paid within the period of 90 days or whatever it is. It's a stop. Then it goes into SMA 1, SMA 2, then that becomes a bit of a challenge for the banks also. So these are a couple of factors in the banking side It's not really taken off the way we thought it would be. But yes, on the corporate side, it has done well. Uh, there is, of course, competition, but it has done quite well in the corporate side. We have a fairly good base of customers. And across the industry, I would say, when you compare it to other industries, maybe it's not as big. But in the trade credit space, my sense is that it will be around 650 crores, not including ECGC, in terms of gross premium. So that would be the size of the market. Traders, of course, in India has the largest market share, about 35%. And the rest, of course, you have the private players like AIG and Coface, Lombard with Coface, and AIG and SBI, etc. So those are the ones that really are the players in the business. So to answer your question, yeah, it has been a good ride so far. We've been taking the guidelines as it comes. They've been very positive developments. And the good thing is the IRD has taken cognizance of the need of today and has, in principle, they are quite open to discussion, etc. They've allowed in single buyer kind of cover, which wasn't there earlier. They've increased the indemnity percentage from the earlier it used to be 85, and now there's no restriction really. But yeah, we can give indemnity even up to 90-95%. All depends on the deal, of course. But there's these relaxations that have happened, and it's all good for the industry in general. So that's really my initial thoughts.
Thank you.
Thank you. Thank you.
Well, I
So
think
I think
there's an
I think
echo. Yeah, it's better now. Thank you. So, I personally feel that factoring and trade credit insurance are uh, are two parallel tracks. They are they sync well because I in general it's a observation that around 30% of balance sheet size is contributed by only book debts,
Yeah.
and if businesses can avail factoring, that portion of the balance sheet is slightly eased up. Plus, when factoring is availed along with trade credit insurance, it becomes a non-recourse kind of a facility. So it's quite a useful facility, especially for large exporters and for large domestic players where cash flow is is a constraint, and along with a good capital, you also need a good cash flow, and that's what will help in meeting the next order. So with that said, sir, can you please explain how uh, the factoring and this trade credit insurance product are particularly important while dealing with overseas customers where there is a limited track record, or probably a seller in India might not know about the financial standing of the buyer based abroad. Leave alone sellers, even financial institutions might not be aware of the financial background. So generally, what happens in USA and Europe is that not many entities publish their balance sheets in the public domain. So can you please elaborate how this product helps?
Yeah. Yeah, absolutely valid point. I mean, both the products, factoring and credit insurance, are integral solutions to a good debt management system. Okay, so one provides working capital, cash for the business to be agile and make sure that the business continues in a way that is it's not constrained for raw
Absolutely.
material, labor, etc., and day-to-day expenses. So that is a great facility for sellers to avail of cash by factoring their portfolio, factoring their debtors. And I'm sure that a lot of companies, especially in the SME sector, who are desperate for working capital, and they often don't find that to go to banks, etc. It does take its procedures, and the level of working capital finance available would be limited because they may not have the background to avail of such large. So factoring is definitely an excellent tool for effective working capital management. The other side of the story is insurance. So while factoring helps in cash management and effective working capital management, and as you rightly said, debtors is the only item in the balance sheet that's really not insured. Okay, so that's something that is everything else is insured. So it makes sense for that to be also insured. And that helps both in terms of the factoring company getting comfort that, well, if I then factor these receivables, they are good quality receivables. So you can offer competitive rates, maybe comparing it to banks, etc. So an NBFC, a factoring company, normally is at a slight disadvantage when it comes to the rates and offered by banks. Insurance that factoring helps that cause. That is, the quality of receivables will be determined by the insurance backing. And we have a very thorough underwriting procedure. Of course, factoring companies do their due diligence. India Factoring, for example, does a very comprehensive seller onboarding and buyer onboarding, etc. Various metrics that you yourselves do. But that's the first stage. Now, what happens if the buyer, the transaction goes bad, or the buyer you don't have sight of, or there is sometimes it could be a connivance between the seller and the buyer. You don't know that. So in such cases, credit insurance helps a great deal because not only do they evaluate the transaction, but they have the buyers that can be underwritten. For example, a buyer outside India. Now, a credit insurer such as us have the underwriting capability to have underwriting, the fact that we can do underwriting across all geographies. So, which means that a physical underwriter is present in, let's say, the US or various parts of Europe or Asia to actually assess the buyer and actually come with a limit. So yeah, so it is more than just tick in the box. It's more than just what you get in public domain. I mean, we have the concept of a closer to buyer underwriting, which means that the closer you are to the market, the better you can evaluate. Like for example, in India, if someone tells me to evaluate a non-cooperated entity sitting somewhere else, it's not possible. So only when you have local expertise and local knowledge can you underwrite these buyers. So this is a principal advantage that a credit insurer offers. So across the country, across the geographies, we have a physical presence there so that the underwriters can actually see and actually underwrite the buyer based on their merit, even though you may have limited financial information. And that's absolutely right. In US, for example, it is you don't get information to the granularity that you want. So this is
Absolutely. Absolutely. And I think Atradius is present across 60 or 65 odd
yes,
countries.
countries. Yes,
That gives a definite
it's a good,
advantage. Yeah, it's a
absolutely, it's
it's
a
a
good
great
brand.
tool. Yeah. Sir, Arunji, I think there was a question from our audience. This
Yeah,
is Weber. This question
yeah.
is from Weber. Weber is asking, what are the common misconceptions about credit insurance, and how can businesses avoid them?
Yeah. So one of the things that a credit insurer, one of the misconceptions, it's a financing thing. It's not a financing thing. It has got nothing to do with finance. It's about protecting your buyer, protecting a seller from getting a default risk against the buyer. So we don't give loans. There is no finance angle here. It's a trade transaction, and that's some misconception a lot of people have that if you give a arrangement of a loan, arrangement of financing, no, it is purely non-finance trade related transaction. That's number one. Number two is that you will not automatically, if you pay premium, be entitled to a limit. That is the reason for that is that the underwriter has to underwrite. He has to see and check. It could be a partial limit, it could be even a zero limit. In fact, a credit insurers act as advisories. So you wouldn't want to deal with a customer, a buyer that has a bad history, has a bad claims record. So very often I get asked that, look, we paid your premium, so assume that you'll get the limit. No, we don't. Yes, it's good to have a high risk acceptance across the portfolio, but sometimes we don't do that for the simple reason that the buyer itself is not in a position to, there is a bad financial history. So that's the second misconception. Third is that, well, it's too expensive. Well, it's not. Actually, it's not expensive because if you see the cost benefit analysis and just see a very brief, let's say you have a portfolio of 100 crores, let's say, and you have, let's say, 100 buyers, and each buyer would average limit of, let's say, a crore or 2 crores, which is normally the case. Because in India, what we've seen is that even a smaller mid-size SME has a lot of buyers. So it's not a very limited buyer spread. It's a huge buyer spread, even of the SME sector. Large sectors, of course, are huge. They could have 2,000, 4,000 buyers. That's the nature of the country. So imagine you're paying 20 basis points or 22 basis points on a 100 crore turnover, estimated turnover of credit turnover, and you're paying about 22 lakhs. And then let's see just one of that goes bad, which has an average is limit size of a crore. I'm not even taking two. I'm just taking one. One limit goes bad, and you're out of pocket. And here,
Correct.
by 22 lakhs, you're indemnified for the entire 90% of that 1 crore. You're actually indemnified for 90 lakhs. So there's a massive advantage for customers, corporates especially, in the scenario that we're in now, and the way the volatility is happening, that it makes sense. So there's also a misconception that's a very costly product. So this is very common misconceptions.
Okay. Thank you. Thank you. Moving on, sir, I was going through the insolvency forecast report, which was recently published by Atradius. Bad debts have declined in Asian markets, but the global rate of insolvencies is expected to increase by around 34%, and that's whopping this year. And it's expected to stabilize in 2025. So that 2025 is a good 9 months away. So we are looking at it's a worrisome trend, at least for the short term. So it may be high time for exporters to be
Yeah,
on the on the right side of caution. So can you
yeah.
please share your views on this? Would you advise more caution in any specific region? Uh, do you think that Atradius will be able to cover high risk regions also?
Yeah, a good question. We often have this economic analysis and forecasting for insolvencies. We do it on a year-to-year basis. The latest report we did in March of 2024, where we sampled, I think, 29 companies, which was sampled across Europe and US and stuff like that. So what happened here is very interesting. So there are some cluster of countries who showed more insolvencies in 2023 as compared to the pre-pandemic level. In fact, it was even more. So all of us
Okay.
know that during the pandemic, the insolvencies were very muted, depressed, purely because of government support.
Correct.
Uh,
Correct.
Particularly true in India because India had limited government support. In OECD countries, there was huge government support. So that entire the whole insolvency scenario was muted that time. So there is a lag effect. So in 2023, there is a cluster of countries who showed a very high level of insolvencies, more than the pre-pandemic level. I would probably call it, I don't know, new normal or above average new normal or whatever you want to call it. But there are also a cluster of countries who showed below pre-pandemic level insolvencies in 2003. So there are two kinds of sets of countries that are very interesting to see. The ones that showed insolvencies more than pre-pandemic levels in 2003 are likely to have less insolvencies now because the lag effect has been factored in. That means that these companies should have now factored in that withdrawal of government support, and it all
Correct.
happened in
Correct.
2023. And in probably 2024, those cluster of countries, I think maybe, I don't know, so Finland or Ireland, let's see, 6 or 7 countries in Europe, because the sample was Europe and US mainly. Hong Kong, Asia also was there. These were probably show less growth rate of insolvencies in 24. But the worrying factor is that there is a lot of countries, US dominated, US leading the way on that, which showed muted insolvencies in 23 because of the lag effect and wasn't fully factored in. And these are the countries, Netherlands, US, Poland, Hong Kong, quite a few of them. That Italy was a big one. That will now start showing in 2024. So this is something that is going to happen, and that's why the projected rate of insolvencies in 24 is in the region of 16 to 17%, which is huge. And there's a double whammy here. The second part of the whole problem is that the global economic recovery is pretty much done and dusted. We had the post-pandemic recovery, all that happened, but now the central banks have not been very, they've been pretty cautious across the world,
They've
even.
been
And you won't expect a loosening of monetary policy just like that. You will still have targeted inflation numbers being done all across the world. And I don't see any central bank as of now really loosening up on their monetary policy as of now. That gives a classic stagflation situation where you have high inflation and low demand because of the economic growth being what it is, very, very low. Almost between zero point 0.2 to 2.4% is the max that we are talking about in the global average. So on the one hand, you don't have demand, the aggregate demand has gone down, and then inflation has gone up. So it's a stagflationary situation that companies will face. So they will have problems in getting capital from the market because of the interest rate, and also coupled with possible insolvencies that you would have. And there's another aspect of a lot of these, what we call zombie companies, which are effectively wouldn't have done very well even in the good times, but they've been stepped up and propped up because of government support. And now that it's not there, these companies will also face a lot of headwinds and probably result in a lot of insolvency. So this is where the problem is. So, and US unfortunately is the leading in that. They are leading in the potential growth rate in insolvencies in 2024, and that gives worry to exporters to really be careful about OECD, especially the OECD, some of the OECD countries. Singapore, for example, was a low grade in insolvencies in 2023, but potentially large here because the withdrawal of support was not factored in. So this is where the dynamics are. So we have to see which quadrant or which area this clusters of country are, and what countries you're actually supporting, what countries you're actually exporting to really know potentially. It's all very hard to say, but this is generally what we see, that initially when insolvency is high, there's potential that it will stabilize. Initially when insolvencies in 2023 were low, there's potential that the insolvency. But somehow, definitely, all of that has to factor in. It has to be factored in. So the lag effect will be there, and of course the economic headwinds, and of course notwithstanding the geopolitical crisis that we have all across the world. So there is cause of worry. So definitely, exporters should be cautious while dealing with buyers overseas.
Absolutely, absolutely. I think you summarized the situation in the U.S. Bullseye. That was a bullseye kind of an analysis. The FOMC minutes, which were released around a fortnight ago, it's quite a contrast from what it was in January. The market expectations in January were that rate rate cuts would start, but I think Jerome Powell indicated that rate cuts would be delayed by at least another quarter or so. So that had spooked the investors. So absolutely, you're right. I think there was an audience question. This question was from Gopi Krishna. Gopi Krishna wants to know that RBI has allowed insurance on uh, TREDS product, which is
That's yeah.
which it's a welcoming step. But he says that the execution and early response from the insurance industry is quite tepid. So would you expect any change in the approach in this fiscal year?
Yeah, just a minute, please. So Gopi is quite right. I mean, Threads was there to act as a huge, enhancer, enabler for SMEs and MSCs to be on the market to get cash, and then obviously the buyers are large, etc. And that would help financiers auction the invoice on the platform and get the best rate, and then offer the best rate. Excellent mechanism and a platform to do that. And of course, they also have a very in-depth due diligence process in place now, or before onboarding all of these buyers and sellers. What happened on the insurance point is that this auctioning bid that happens on the Trex platform is on invoice level. They are not on a portfolio level, they are invoice level. So you have multiple financiers bidding for that particular invoice. That becomes a bit of an issue for trade credit insurers, typically who are generally portfolio driven. They want a portfolio, they want a whole turnover of those. So this is where I think there was a kind of a mismatch where it could be also because of technology, where how do you then bundle invoices and actually give limits on an invoice level, which becomes a bit of a challenge for us. But we are working around that thing as to how we can do it. For example, offering a portfolio, let's say a financier, his portfolio of buyers that we could probably get into credit insurance. Because at this point, there are very few insurance companies who have the capability of setting limits on invoice level. It has to be almost, and it's real time, so it has to be immediate. So it has to have some kind of a standard threshold dashboard kind of situation where you automatically then issue limits. So we haven't kind of reached there, and that's the reason why the response has not been that much because of these constraints that an insurance company has. So we have to change our model and change technology. That would happen definitely, and we've been having discussions with various stakeholders and trends. But yeah, we should come with some solutions sooner or later.
Okay, thank you. Arunji, moving on, I'm quite curious to understand what is, or rather, what has been Atradius' experience in South America or the African regions, because a bit of trivia here for our audience, but and our audience might be well aware of all of this trivia also, but then these nations are very rich when it comes to natural resources. You'll not, it'll be interesting to note that 30% of the world's minerals are based at Africa. 40% of the gold production comes from Africa. 70% of the world's cocoa beans come from Africa. And I can't imagine a life without chocolate. So that is where my curiosity is based out of. It's such a uh,
Yeah.
abundant resources kind of region. So what has been Atradius' experience in these two zones?
Uh, yeah, to be honest, insurers are very traditional. Okay, so we will follow certain norms of country risk, country coverage, etc., etc. That's always been the case. But as I said, it's nothing is cast in stone. These are constantly reviewed by what we have,
Absolutely.
we call country committees, to see whether it can be an open cover, it can be an LC cover, because insurance companies only have three modes. It's an open cover, it's no cover, or LC cover. So that's how it is. Soft cover or LC cover. So there are countries in Africa that we do an LC cover, but in sub-Saharan, we still, to be honest, are still a lot of off-cover countries there. It will take some time to get on open terms with these countries. That's a statement of fact. I think it does take time because we need the level of understanding of the legal system, the economic system, the political system, etc. We do that analysis and understand the way the country cover is generally done. So a lot of African countries we do. We have a presence in South Africa also, so that's something that we do. We have a presence across in the Mediterranean side. That's there. In South America, we have a large presence in Brazil. So we do have underwriting happening in Brazil, especially in the agro space. We've got fairly good. But there, I think the important point is recovery. So we have to have a very robust system of collections and recovery, which is also something that Radius does as part of the offering that we give our customers. Of course, we do the credit insurance, but we also offer recovery and collections across the world. So it's called a Radius Collections. So that's also part of the. To answer your question, yes, in South America, Brazil has been a bright spot. Of course, there are quite a lot of claims too, but we operate quite effectively in Brazil and other Portuguese-speaking areas. So it's yeah, it's I would say it's on par with, let's say, Asia in terms of risk acceptance or even the Middle East for that matter. But we're slowly getting there. But in Africa, sub-Saharan is a bit of an issue even now.
Okay. Yeah, these are tough. I mean, yeah, tough regions to deal with because they have had a history of civil wars and a
Yeah,
lot
the
of.
political, economic, social, everything is something that we need to analyze. So, yeah.
Absolutely, absolutely. Sir, yeah, we have another question from our audience. This is from Asha. Asha wanted to know whether there are any limitations or exclusions that businesses should be aware of while purchasing trade credit insurance.
Yeah, I should think a standard exclusion. We don't cover interest. We don't cover, stuff like disputes, war among foreign nations, goods that are not accepted. Clearly, that there is a clear thing that non accepted non acceptance good is something that we do cover, but especially when there is a goods that have been delivered without quality, etc., and non acceptance, those are not covered. Disputes, it will come under disputes. So majority of the exclusions would relate to interest. Of course, we don't cover, but the major part of where there's always this thing about what should be covered and what shouldn't relates to disputes. So yeah, that would be a major. I wouldn't say that disputes are not covered. It is covered to the extent that the buyer and seller then come to maybe an arbitration agreement or the judgment in favor of the seller, in which case the claim is still paid.
Okay. So moving on the same topic, do you feel that in cases of disputes, the buyers have a upper hand? I wanted to ask this to you long back, but then now that this question came up, I was prompted to ask this. And do you feel that once a dispute is raised, it becomes a sort of challenge for factoring companies, because on one hand the buyer says I won't pay, and on the other hand a factoring company would have already given 85% or 90% of the invoice. So how do you deal in these kind of
Yeah.
situations?
No, I think we've been in this business long enough to know what a genuine dispute is. The rejection of claim because of the buyer just saying that I'm not going to pay is almost, minuscule. We do not
Okay.
reject claims based on just the buyer claiming that he doesn't like the product,
Okay.
because there is clearly communication between the buyer and seller that you've sent the goods, you've received the goods, you've accepted the goods, you've actually then done some kind of dunning to recover your money. And all of that is proof that the money is fully recoverable. The only reason why disputes come up is that when the process is starting and then the buyer comes and says, look, this is the sample that you gave and this is not the sample I got. And therefore, by proof, I can tell you that this is an issue. That is the only way where goods. Then, of course, we say that look, if it's a question of quality sample, sale by description, or by sample, whatever. If those are not fulfilled, then you figure it out, and then because we are not adjudicators, we are just insurance company, so we don't know the technicalities of the product. It could be a textile company with selling yarn. We don't know the intricacies of the filaments and stuff like that, which is something that the seller and the buyer will have to do. But in most cases, that's not the case. In most cases, the potential reason is non-payment. Okay, and we have clear communication of loss. See, one of the policy conditions is also loss mitigation efforts that the seller has to do. So if he doesn't, just he sells the goods and just keeps quiet, and then suddenly the buyer says no, then there's a slight problem, because at the end of the day, insurance is a backup. You should do your product, and you should be doing your business the way you're going to be conducting business without insurance. So if a buyer doesn't pay, then clearly there would be some loss mitigation efforts that the seller would have done, dunning, or filing a case or recovering, or section 138 or something. So in cases of some 138, it becomes a particular issue that if we pay the claim, we become subrogated to the debt, which means that we are in the shoes of the seller. And if he has not filed a case in 30 days of the issue, then we have a problem. Our recovery is compromised. So that's why we lay a lot of stress on loss mitigation processes that seller is expected to do. Otherwise, we don't see any claims being rejected because of the buyer telling that, I won't pay. That's clearly why the insurance is taken.
So am I right if I state that as long as the seller and buyer have been in touch with each other quite often, quite regularly,
Absolutely.
the chances of these kind of
Rejection.
disputes or these kind of things go away?
Yeah.
Thank you, thank you, thank you. uh, Moving on, sir. Many of our clients often ask this: what is the difference between ECGC cover and a trade credit insurance cover?
Yeah. Yeah, there are lots of differences. Well, not lots of differences because at the end of the day, ECGC helps the exporters. That's the primary role of the ECA in any country. Whereas private players, the role is to offer, mainly they offer the whole turnover product predominantly. So there's no selectivity involved here. Whereas in ECGC, you have various products. You have single buyer product, you have the multi-buyer product, you have single shipment. So those are there in ECGC. The reason it's there is because you have these large export houses that do multiple shipments and they don't want any disruption in that. So they generally opt for multi-buyer policies where there is a carte blanche cover on these buyers for a particular fee, which is not the case in private players because each of the buyers are physically underwritten and a limit is given. So that's your first major difference between the multi-buyer policies, which the private players don't offer. Of course, ECGC also offers a whole turnover and single shipment. And the guideline now, the recent guideline IRDA has also allowed private players to offer a single buyer, but then that's possible. That's entirely possible. ECGC also offers project covers. Private players do project covers, but in a limited way. The second important difference between ECGC and private players would be the pricing. Now, ECGC has a fixed pricing. They, of course, give discounts based on the turnover size, the export house rating, discounts, etc. So you will have a fixed pricing. In private players, that's not the case. Every single proposal is priced based on the merit of the case. So you won't have a fixed, kind of a pricing for policies in the private space. Third would be the ML, the maximum limit of liability. In ECGC policies, it is a function of the fraction of the estimate of the turnover. Whereas in the private players, it is a multiple of the premium you pay. For example, if I pay a premium of 1 crore, I would give you a maximum liability of 40 times, 50 times. So your total liability for the insurance company is about 50 crores. That's another major difference. The other one, of course, is the country coverage. As I said, in private players, it's either off cover, on cover, or LC. Now, in ECGC, there's nothing like that. They have this category of, a concept of coverage to all except for those that comes under the selected list of adverse information or restricted cover markets. So in those markets, of course, they're easy to get, but as a rule, they do offer cover, especially multi-buyer policies across markets. In private players, that's not the case. We certainly, like I told you about Sub-Saharan Africa, they're straight away LC. Being in countries like Bangladesh, they're on LC. Sub-Saharan Africa is off cover. Countries like even Bangladesh are on LC. So these are, and then of course you have the DCL criteria, which is the discretionary limit which insurance companies give.
Absolutely.
In ECGC is generally 5 to 10% of the aggregate loss that you can give. DCL in private players is a function of how good the credit management systems are of the seller. Then another difference would be on the recovery part. Recovery in private players, sometimes we offer collection services that are free up to a certain point, and in case of legal, costs that we need to take and lawyers and stuff like that, we can share the cost in the ratio of indemnity. Whereas in ECGC, everything is outsourced at the client's cost. Yeah. And then, of course, the most important thing is the recovery rights. Now, if you get the money, right, the first right of recovery goes to ECGC. Whereas in a private player, again, whatever recovery is done on the basis of the indemnity. At least in the trade it's done like that. So we give that benefit to our customers. And lastly, I think the ECGC charges, I think, some kind of a processing fee, which the private players don't. So these are generally, and there's one more. I think there's a extension period. Yeah, private players can give an extension period up to 60 days, which means that even if there's a due date and 60 days over and above that, that is still covered. In I think ECGC, it is I think just 30 days extension beyond the due date. So these are the broad differences.
So can I state, or can I summarize that trade credit insurance from private parties would be more agile, it would be more customized,
Absolutely.
it would be
Absolutely.
because of your presence in several countries, you would have an on the ground understanding which
Absolutely. That is
which
exactly the truth. That is exactly the truth. So, in
nice,
fact,
nice.
we are uniquely placed to actually do outside the country because of the fact that we have close to buy underwriting happening there. In fact, we act as red flags to to the businesses because the moment I have a claim in some other policy, I will then inform you that there is a claim paid for some other policy, which immediately pops up in my system. He might be paying you regularly, but clearly there is distress somewhere, right? I mean, he's not paid somebody, and there's a claim on him. So those are red flags that are given to our policyholders, and the policyholders would like to have that advisory because they are the ones who are running the business, and they're also in risk, even if not the full, at least 10% they are on risk, or 15% sometimes. So this
Absolutely.
advisory part can happen only if you have your people on the ground.
So it's more proactive.
Oh,
It's
absolutely. It's very dynamic. It's very dynamic. Even the pricing, the way the policy structuring is done, is not very templated. It's very based on the requirements. It's very, very, very customized.
okay. So moving on, given the evolving geopolitical tensions and so many other things are quite volatile out there these days. The Ukraine crisis seems to be never ending, and the Middle East is always on a boil over the last 2 3 months. So in this background, I had certain observations. Political and economic circumstances can affect the trade quite a lot. So they can even prohibit supplies, or they can prohibit payments. So examples of political risks include riots, civil unrest, war, and changes in trade regulations or weak banking systems. The recent example, not so recent, but then a significant example was that Russian banks were removed from SWIFT. So what has been your experience of political and economic situations that hamper trade, and why does the cover cease in case of war between big five like USA and UK and France?
That is standard exclusion. That's nothing that we can do about it. That's standard exclusion across all products, all insurance products. But in terms of the how we deal with situations like this, a good example being Ukraine, Russia. We do understand that notwithstanding the geopolitical situation, the underlying contract, the seller and buyer still is there. So we actually help the seller or the buyer to actually complete those transactions, and we don't immediately withdraw cover. That's been quite successful strategy for us, even in the height of pandemic. So this is the same approach we do while the process of a situation like the Ukraine and Russia, where we didn't have much losses. You'd be surprised
Okay.
because we worked around the transaction, worked around the suppliers and the sellers, and then make sure that the payment will come. So that's the same approach we took during the pandemic, where we work. We know that it's going to be a domino. The fact that the buyer doesn't pay the seller, the buyer in turn has not been paid by his buyer, etc. So there's a domino. So we understand that. So you can't penalize the buyer for not paying because of this. So what we used to do is we avoided this involuntary withdrawal, which very often insurers sometimes do some trigger happy actions, which is actually counterproductive. So we don't do that. We allow the seller time to kind of report his claims, try to make that process, because the waiting period is about 180 days from the last date of invoice. We extend that so that there's still time for the seller to then recover the money. And we also do stuff like rotational billing, where we can, you can we can do an 80-20, where majority of the 20% is given in 80% is given in cash, and the 20% goes into the adjustment of the previous outstandings. So we do rotational so that business is not suffering. You still can deal with the business, because if you withdraw, then you can't. So we
Yeah.
avoid kind of trigger happy kind of actions, which will directly result in claims, because then the person has no choice but to lodge a claim, because there is no way the business continues. So I think our focus is mainly on ensuring that bona fide businesses continue with their trade, and we help the process. We help the process by asking the seller to reduce his exposure on shipments that he doesn't want. For example, there is a huge limit set on a particular buyer, then he can just analyze the trends as to how much shipment he's giving him. If he's not going to use it, then surrender it. So those are the kind of things that we do to reduce the exposures and ensure that our potential exposure goes down.
Amazing, amazing. Sir, some exporters often take insurance on their own for their buyers, and some others take it through financial institutions like factoring companies. When exporters take insurance cover on their own, are they able to properly follow all the insurance guidelines? Are they able to understand the nitty-gritties? So, what has been your experience on
No, no,
this?
it's a good question you asked, because you see, the main business of any business is to do business, right? He is not going to be looking at his primary motive is not to ensure that, well, I have a credit insurance cover and have I fulfilled all the policy conditions and not breached any of them, and then at the event of claim, I'm sure everything is done. So we understand that. So there are two ways of looking at it. One is our own way, there's a direct approach, which where there is no intermediary involved. So what we do, we have independent account managers handling those particular accounts. So we also understand that their core job is to do their business. Their core job is not to see whether we breached, etc. So there's a constant training, constant learning, constant reiteration of the product by our account managers to the policyholders, because it's very often you can forget. I mean, you suppose one of the policy conditions is you have to report your per turnover declarations. If you don't, then well, this is something. If a claim comes and the premium has not been paid, because in India you have the premium paying and then the turnover. So this non-declaration of turnover, non-declaration of outstanding, non-reporting, let's say a non-payment notification, because it's also mandatory that before you set up put a claim, if the person is not paid in the credit period, is not paid within your extension period, in which case you'll have to notify us. And that could be a result of, that could be, the non-observance could result in a breach. So these are things, there are nitty-gritties, as you said, there are quite a lot of them. So we need to, educate our customers more often than not, especially on the claims side, as to what documents are required, what is the kind of norms, what are the timelines of ensuring that there is no breach. So this is a constant, part of our account management team to do that. And ideally, if they have a broker, then the broker does that. So that education happens by the brokers. So my advice would be to take the assistance of brokers. I mean, they are specialized insurance brokers who know the product, and they will flag off any potential breach to ensure that you do your business, concentrate on your business, and let us do the credit management and claim recovery and stuff like that. That's my
So,
advice.
yeah, so adding on to that, I would also I often tell this to many clients that they should leave documentary requirements and specifications of the products to the financing organizations, because we are the sort of experts. We have been in this line since 15 odd years, so we know the documentary requirements. We know the implications of say a incoterm like DAP or incoterm like DDP. So we know the implications. So maybe exporters would do well to increase their business and leave the documentary specifications to experts like Atradius or to people like India Factoring.
Absolutely.
Uh, sir, last question before we sign off. What is contract frustration insurance, and is it being regularly offered?
We do offer it, but it's part of trade credit insurance. But yes, we are definitely it's part of our product, a suite that any person with a contract has not obviously not adhered to the contract and frustrates that. That is definitely covers. It is covered under the trade credit program. But
Amazing insights.
we don't have too many cases like that. But yeah, it is definitely there.
Amazing, amazing. So I think we are approaching the end of our show today. So I would like to place my appreciation for our eminent guest today. Arunji, it was an absolute honor to have you on the show. Thank you for the wonderful insights. It's been very interesting to
Yeah.
discuss with you.
And thank you so much for inviting me. It's been also an honor to be part of the show, and I hope what we discussed gets some value to your audience and people who are listening and seeing this program.
Absolutely. I thank the audience for the interest and for the time invested. India Factoring conducts such sessions at regular intervals, and we will come back with another session quite soon. Meanwhile, this is Ramanathan signing out. Until next time, thank you.